And this one was called Contextualizing Development Risk. Very boring title. I would completely retitle that. I would maybe call it, what's happening in apartment construction. You won't believe what the answer is. That would be my clickbait title, but maybe something better than Contextualizing Development Risk, because it unifies and it comes up with a lot of ways to see what developers are facing, what kind of decisions that they have to make, and how really risky it is for developers. And I will, as I get into this, I'll note this, but I would just want to highlight the idea that developers have to predict the future. They've got to see 2 years in advance, because their apartments aren't going to get built instantly. And who knows what the financing, what financing is going to look like, whether they have to secure it at the start or, at any stage of the project. That's probably going to impact the saleability of their, of the product that they're going to build. So they don't want to they don't want to build and suddenly find themselves in a high interest rate environment, I'm thinking. And then on the flip side, they also don't want to build, on the demand side, they don't want to build in an apartment market that suddenly has a whole lot of apartments. Now, I don't know if they call each other or talk to each other and it's like, hey, I'm going to build here in 2023, and you, my competitor developer, are going to build in 2025. I don't think they're doing that, but maybe they are to a certain extent. They're maybe coordinating. But yeah, they've got to know what their competitors are building. They've got to know what the interest rates are going to be. They got to know, all the other like normal stuff like population and economy and job growth and all these other factors that would maybe determine apartment market performance. But man, it's a cauldron. It's a real witch's brew they've got to peer into to determine the future. And I'm not magic. I don't know how to do it. And hats off to developers for taking on these risks.
I was going to say, I think that's where government incentives come to play.
Yeah.
So enticing construction.
That's a good point. Yeah, the government is the magic. But yeah, so really did like this report. And their takeaways really quick. A little bit different than mine, but I will note theirs because they highlighted themselves to the authors. Their key takeaways are that 2/3 of construction today is mid or high rise, which is a significant divergence from the 2000 to 2015 construction, when 2/3 was garden style. And they also note that challenges in financing as well as rising construction costs have put pressure on development proformers, putting downward pressure on starts, just like you noted, Addison. People aren't going to build. And you'll see the figures in terms of their expectations for completions in the next couple of years. That's going to those numbers are going to be lower because they're not building now, so they're not going to complete later. They also say that most markets with large pipelines today are high growth markets that have benefited from outsized in-migration in the wake of the pandemic. So these typical markets, because they see outsized demand, maybe the construction figures might really overstate the supply risk. Maybe we're not building too much because they'll just grow to meet that demand. I have a little bit more skepticism to that because I think that some of that outsized in-migration was a finite phenomena, but they still are. And the places that were growing, that people were moving into during the pandemic, that was exacerbating pre-existing in-migration trends. So it wasn't like people suddenly discovered that Phoenix existed or that Boise existed. They were moving in there a little bit before. And now they'll still be moving in there a little bit, more relative to like a place like Chicago. But still, I think that there's some bounce back. The U.S. and finally, and I noted this earlier in the report, the U.S. housing shortage likely means vacancies will rise in the near term, but fall quickly as new supply is absorbed. We still don't have enough supply nationally, and maybe even, a lot of these markets. You'll get a little bit of a bump up in vacancy, but ultimately the size of the housing affordability crisis is such that it is larger than any 1 year of construction. Okay, so that is their takeaways. One of my takeaways is that supply can really ebb and flow in and out of markets. For instance, they note that Phoenix had a tough go of it. Now, I've noted this in our conversation with Spencer and maybe a little bit earlier in this report. They note that Phoenix had a tough go of it at the start of the Great Recession. So I just want to quote this here. During the Great Recession, Phoenix saw one of the steepest declines in occupancy as a result of 15,000 units delivered from 2008 to 2009. In hindsight, the market appeared to be overbuilding into a recession, but most projects delivered in 2008, 2009 likely started in 06 and 07. From 2005 to 2007, Phoenix's population grew by 3.7%, which was faster than any major metro has grown since 2010. So, had population growth remained robust, apartment demand would have largely kept pace with new deliveries. But they just got on the bad side of something that they couldn't see 2 years before, and that's like not their fault. I think it's interesting that you're kind of seeing that now. Phoenix is building a lot, and rent growth in the market is dipping back down. And I think that another really huge point is that the effect of this construction could be different based on the size of the market. Phoenix may not be at that size, and I may have noted this earlier, where a smaller market can't take 15,000 units like a bigger market can, and so it makes them a little bit more sensitive. Now, on the long term, it's got those growth numbers where you can really be confident, but you may not be confident there may be 1 year where you're really dealing with lower occupancy, I think. But again, like the long term is where you'll kind of make it back. Another point for this article that I kind of pulled out was this enormous effect of construction slowdowns that have led so many projects to be still under construction at the same time. We could see significantly elevated levels of construction of completions this year, but the next couple of years, it's probably expected to come down. Now they have a chart here, and this is what you referenced to, Madison, is these are construction levels, and I want to look at the timing of these construction. Nope. Is it here? Is it here? They have a year by year. There we go. Okay. Completions are expected to fall in 2024. 2023, we're expected to have 485,591 units. Exactly. I'm not sure exactly how they got that number. That may change. But then and next year, it's expected to fall all the way down to 200,089,613. And then in 2025, it's less than half of what it was in 2023 at 220,682 units completed. So, we've got a log jam now, and we're going to maybe complete a lot. My guess is we will see closer to 400,000 completions this year. And then next year, maybe, 300, in the year following, maybe closer to 27. I don't think that this year will be as high, but maybe 2024 and 2025 will be, if this log jam, if these construction completions really are a significant factor. And I do believe that we have, here is this divergence here in this, you can see in this line graph how and it's really interesting. The divergence did not necessarily begin at the pandemic. It began at 2010, and it really, from 2010 to 2015, it started to really diverge. This is this baseline divergence between completions and apartments under construction. And then it was a fairly steady from 2015 to 2020. And then it diverged even more. So right now we have 926,000 are under construction, and only 359,900.
They have a reasoning for that?
For the divergence now?
Yeah.
Yeah, it's the slowdowns. It's all of them were started and they couldn't get completed. And let's see what they do say here. The construction timelines are further elongated by delays for permits, material shortages, and the availability of labor. Ongoing challenges across the development landscape. Now, there was they're talking about from the Multifamily Housing Council. They're citing these ongoing challenges. Now, there was a newly released report that says that these conditions are easing somewhat, but they still haven't gone away. And a lot of these challenges are in themselves kind of give a little bit of a feedback loop, because with more projects ongoing, you probably, even if everything was met, all of these supply chain issues were met, the fact that there are so many projects undergoing, happening at the same time is probably going to slow down any single one of them.
Yeah.
But that's just my own personal thought. And okay, so finally, while we gone through similar figures before, I've added this Cushman Wakefield report at the last minute because I did want to get at some of these figures they have for units under construction as a percentage of current inventory. And they have a couple other ways that they're looking at the construction pipeline that I want to highlight. Some that maybe make a little bit less sense to me. This one's very straightforward, and I at least like how they have ranked these markets by units under construction as a percentage of current inventory. So Miami is at the top at 15.7%. And then Nashville, Austin, Raleigh, Charlotte, Orlando, Northern New Jersey, Salt Lake City, all of them. I mean, Salt Lake City is at 9.7, but after that, they're at 10% and above. Now, if you go all the way down to the bottom, you've got Norfolk at 1.5, and then Tucson at 1.8, Baltimore, Detroit, Orange County, San Diego, Oklahoma City, Memphis, LA, Cleveland, Sacramento, East Bay, Chicago, and Indianapolis at 3.1, St. Louis, Houston. All of those are, 3. St. Louis is at 3.3%, and those other bottom, lower supply markets are at lower, around 3 to 2%. A far cry from 15.7%. But they will caveat that, and they will say that overbuilding is a function of demand. And they'll say that, actually, let's look at what they say is years of construction. So they're taking their units under construction, they're dividing it by the average annual demand, and they're finding, and they're kind of saying that, yeah, okay, Miami did have the largest when it comes to units under construction as a percentage of current inventory. But when you factor in the demand, it's actually the third biggest for incoming supply. It's outpaced by Detroit, which has a lower demand. So that means that it's going to mean so that their units under construction have a bigger impact. And same for Sacramento. That supply is going to make a bigger splash because the demand isn't there to really eat it up. And I think that largely, though, these two approaches, these two methodologies, whether we factor in average annual demand or whether we factor existing supply, those both, you get a similar list. But I think that what this years of construction formulation does account for is the idea of growth. You may get, you're not looking at existing demand. You're looking at demand that maybe could come forward. I don't know. What's your thoughts? I think it's a little bit easier for me to wrap my head around existing supply, but there is something to be said about you're not taking account the demand that's happened since all this, and all this kind of goes into the fact that there's a lag time when it comes to developing apartments, and you should probably look at some figures that are forward looking rather than looking at the decisions. Existing supply is just decisions that developers made a couple years ago. But if you're going to make a decision now, maybe you look at some other and you kind of factor in the demand.
Well, I mean, not only do I buy that aspect of it, I mean, I really wrap my head around the whole looking at it from the perspective of where and what markets is new construction making the most impact.
Yeah.
Because I don't want to say it's easy to kind of pad stats, but it's easy for different markets to get the development up, but if it's not already a problem.
Yeah.